Okay, let's kick this off. Hello and good afternoon. Thank you so much for joining us today. This webinar is part of our Women in Wealth series, an initiative we created to support women in building confidence and clarity around their finances. At Curi RMB Capital, we're passionate about helping clients achieve their financial goals, and we believe that starts with education and access. I'm Erica Tarrenter, a partner and senior wealth advisor here at Curi RMB Capital. I'm thrilled to be here today, continuing our commitment to the Women in Wealth initiative. Every day in this industry, we get the chance to make a difference in someone's life, and that is what motivates me daily after over 20 years in the field. While my practice is expansive, I get the most energy working from women who are the primary financial decision makers for their families, where I truly get to focus building confidence, educating, and offering a value-driven approach to finance. Women often juggle multiple roles and responsibilities: mother, daughter, partner, widow, divorcee, breadwinner, caregiver. And my goal is to add financially empowered to that list. In my experience, women want to feel that they have a trusted partner in creating their ideal financial future, one who understands the challenges and triumphs of all those different roles and can see beyond the bottom line. Thank you again for joining us today.
Thanks, Erica. Hi, everyone. I'm Olive Mitchell. I'm a wealth advisor and financial planner here at Curi RMB Capital. When I first got into this work as a career switcher, I kept thinking, why am I just learning this for the first time? So much of financial planning can feel overwhelming or out of reach, especially for those who are busy just taking care of everyone else. In so many communities, it's the caregivers, often women, but not always, who are holding everything together. They're caring for kids, aging parents, neighbors, and doing it all just while trying to stay afloat themselves. That's why I care so much about financial empowerment. When caregivers have access to the right tools and information, they feel more confident, more in control, not just with money, but across the board. Because the truth is when we're financially strong, we're better able to support the people we love and protect our own future. And when caregivers, especially women, are thriving, whole communities benefit. Before we dive in, we'd be remiss not to acknowledge what's happening in the markets right now. Volatility can make things feel uncertain and even out of control. But one of the most empowering things you can do in times like this is get yourself back in the driver's seat. Focus on what you can control. And that's exactly what today's session is all about. The steps we're sharing are just as relevant when the markets are calm as they are during turbulent times, and they're designed to help you feel more in control no matter what's happening around you. While the information is useful for everyone, it's especially relevant for women. Statistically, women are less likely to have a financial advisor, an estate plan, or active investments, yet they're often the ones making long-term financial decisions, living longer, and managing more financial responsibilities over time. That's why this conversation matters, and our goal is to make it actionable. We'll talk you through 5 practical steps you can take to elevate your wealth and strengthen your financial foundation. And at the end, we'll have a live Q&A session where we'll answer your questions. So please feel free to enter questions into the chat box as we go along. And Erica's going to get us started.
Thanks, Olive. All right, so the first of the 5 steps that we're going to focus on today to feeling more confident and elevating your wealth is to simply know where your assets are and how to access them. This step may seem basic, but with so many accounts, custodians, prior lives, competing priorities, it's easy for accounts to be forgotten. This is the proverbial finding money under your sofa, but a lot more impactful. On average, Americans hold 12 different jobs over their lifetime. It is entirely possible that you contributed to or received employer benefits to plans that are still sitting inside those accounts. In some cases, I've seen clients be pleasantly surprised how much they have in an old account since it's sat invested untouched over many years. In other cases, there's a disappointment just realizing funds were set in cash and they have not been working for them. Either way, it's a wise idea to consolidate the funds under your watch. If you do have assets that are lingering in former employer 401ks, you have multiple options on how to handle it. In most cases, you can roll the funds into your current company 401k or roll the balance into an IRA or a Roth IRA. There are no tax consequences to consolidating retirement assets as long as it is a direct rollover into account with similar tax characteristics. So a traditional account moves into a traditional IRA, Roth into a Roth. The next category of oft forgotten accounts are those that you opened prior to getting married and never shared with your spouse. As someone who is in the midst of planning a wedding and figuring out life in a new shared arrangement, financial matters can be easily fall by the wayside in this exciting and evolving time of life. Especially as people are getting married later these days, it typically means that they've started to build wealth on their own. It's important to have open and transparent conversations on financial matters and share information and even perhaps access to your accounts with your new spouse. You don't want to forget about accounts that you placed your hard-earned savings into, or that stock account that your grandparents funded for you that may be worth multiples of what it was when you originally inherited it. Speaking of spouses, does he handle the boatload of the financial decisions for the family? If so, make sure he shares all of your accounts, passwords, and important contacts with you. Naturally, in a 2-adult household, you're going to divide and conquer when it comes to tasks and responsibilities. If you are not the one who takes the lead when it comes to family finances, make sure you have a good understanding of all your joint assets. I suggest that you have at least semi-annual meetings with your spouse to get an overview of where things stand financially for your family. Accounts, savings, credit card balances, everything. It's imperative that you know who to contact if you need access to accounts, how to reach them, and how to even access those funds yourself. If you think you have all your accounts in order, I highly recommend you just take a quick peek at your state treasurer's website. Financial institutions are required to turn over assets to the state after a period of time, approximately 1 to 2 years after they seem to be abandoned. You may have abandoned accounts, uncashed checks, or stray stock holdings that are sitting under the watch of the state. So now we're going to transition to action items. One of our key goals here is to give you clear steps as to next steps as to what you can do to ensure that you're in good shape on each of these 5 planning matters. So in this case, I highly recommend that you consolidate your accounts to anywhere from 1 to 3 custodians. If you're nervous about putting your eggs in one basket, at least consolidate your investments and make sure they are held in no more than 3 custodians. Like any plan, a financial plan needs to be cohesive. And if you cannot quickly take stock of your financial picture, your financial life will become disorganized, leaving you feeling out of control. Review your list of employers and double check to make sure there are no stray retirement accounts. Pull your furthest dated tax return and see if there are any accounts listed that you haven't accessed in a while. And just start having regular chats with your spouse to have a mutual understanding of your financial picture, along with key information on how to access those accounts. Go ahead, Olive.
Okay, thanks, Erica. Okay, so now you know where all your assets are. The next step is understanding how they're working together. Are your 401k, IRA, or IRA dollars working for your long-term goals? What are your taxable accounts actually doing for you? A lot of us focus on just growing wealth, and that's important, but it's just one piece of the puzzle. What's the purpose behind the wealth you're building? What are you working towards? What does rich actually mean to you? The best thing you can do for your financial future is to start today. Seriously, as you're watching this, jot down your top 3 financial goals. If you can, put a number next to each goal. They don't have to be perfect, and they will certainly evolve, but getting started is just the hardest part. Make sure your goals are SMART, specific, measurable, achievable, relevant, and time-based. Some examples. In 5 years, I'd love to renovate my house, and I expect to spend X. In 18 years, my now 11-month-old will head to college, and that'll cost about Y. That, of of course, if she chooses to go. We'll have that conversation later. In 30 years, I want to retire. I will probably need 50 to 85% of my current income to do that comfortably, which is the average of what people spend in retirement. Once you know those goals, just work backwards. Figure out what it'll take to get you there. And yes, for some people, that means budgeting. I hate the word budgeting. It doesn't work for me. If you're able to track every dollar you spend, I commend you. Congratulations. But if you don't, and you're like me and you have to find another solution, just work backwards, starting with your goals. Calculate what you need to save each month to reach that goal. For example, you want to cover 4 years of in-state college tuition, around $26,000 a year in today's dollars, and start in 10 years. That could mean saving about $1,000 a month. Depends on how it's invested and how much you already have. When your goals are clear and your savings targets are set, anything extra is yours to spend how you want. Obviously, you need to cover your fixed expenses and you're not racking up any sort of credit card debt or additional debt. But again, as long as you are paying your fixed expenses and you're paying for your goals, anything else you can freely spend. You may have heard about the 20% savings rule. I like that as a guideline. It's a good place to start, but it's not a one-size-fits-all, and it greatly depends on your personal goals. And that is why starting early is so powerful. If you start early in your savings journey, you may not have to save as much as 20%. Or if you start later, you might have to save more. So again, the more time you have, the easier it is to spread out the cost of your goals. Next, make sure you're investing with intention. Your investments should match your goals and timelines. For example, if you're like me and retirement is a long way off, saving in a 401k or an IRA and investing aggressively might be a smart move. I've got time and you've got time, so you can weather market ups and downs. I'm still investing with every paycheck, even when the markets are bumpy and uncertain, because I'm in it for the long haul. Let's take, for example, a midterm goal, like a house renovation. You might be saving in a taxable account with lower volatility investments that can still grow. And if the markets dip, we don't have to do it right that second. We can wait. You have some flexibility with that particular goal. So a question that we get a lot, which I'm sure you're wondering, is what if your income doesn't actually match your goals? Well, that's where planning comes in. It gives you different levers to pull when you have different financial situations going on year to year. For example, maybe you've been meaning to ask for a raise. Now that you see how extra income could directly impact your future, you might finally go for it. We frequently see that women in particular have a hard time advocating for themselves in these types of conversations. Attaching that conversation to a meaningful goal can really help. I believe I'm worth more. I've been wanting to have this conversation. And in my financial plan, that increase will help me fund my daughter's college education. That kind of clarity builds confidence and leads to action. So as you review your financial plan, make sure to be your own best advocate. Another example, maybe a big trip doesn't fit in your budget this year, but spending time with your family is really important to you. What does cutting back $500 a month in retirement spending look like? What if you broke up the house renovation over several years instead of just doing it in 5 or 10 years? Can we make that trip fit? Can we make a smaller trip fit? What flexibility have we created by just simply having a plan? Maybe cash flow is tight this year, but a bonus next year will help you catch up. Maybe you normally tag your bonus for fun and for savings, but because you weren't able to save this year, making sure that bonus goes entirely to savings allows you to continue to march forward towards your goals. And again, financial planning isn't about limiting yourself. It's about creating structure so that you can be more present in creating the goals and steps necessary to get you where you want to be. Knowing your goals are being taken care of actually means you can spend more freely today without guilt or second guessing. And when things change, because they will, it's way easier to adjust a plan than to start from scratch. A couple helpful tools to get you on track to have a financial plan and also to keep that financial plan on track is a financial advisor. I have seen some very impressive Excel and Google Sheets from clients that are absolutely amazing, but again, wouldn't work for me. I know friends that use the app Monarch. I personally use Copilot. And again, it's not for strict budgeting purposes. It's just to help me understand my cash flow. And then, believe it or not, I have actually heard people using ChatGPT as a resource to answer questions and to help set up some of these goals and objectives. All right, so we've talked about action items throughout my presentation in that section, but make sure you have your 3 specific and measurable goals, determine how much you need each year, and then invest them appropriately. Depending on what that goal is in the timeline, make sure that it is actually invested in a way that can help move you forward.
Thanks, Olive. So many great tips. All right, so next we're going to focus on how to save aggressively and strategically into tax-deferred accounts. And this really ranges the spectrum from 401ks, IRAs, Roth IRAs, HSAs. So I'm going to walk you through that and really how you can and where you should focus your saving. After setting up an emergency fund, I think which should be about 3 to 12 months of your fixed expenses, and that really depends on your stage in life and your dependents. It's most important to start thinking about saving in a tax-advantaged way. I want to quickly review the tax characteristics of different types of accounts. Pre-tax savings options are often referred to as traditional 401ks and IRA accounts. They provide an income tax deduction the year you deposit the funds. The funds grow tax deferred, and when an income tax is paid at the time of withdrawal of the funds out of the account. In most cases, the government requires you to take funds out of pre-tax accounts at some point in the future, usually by your mid-70s. Roth accounts are post-tax, meaning your contributions don't provide you any benefit upfront, but down the road, your assets have grown tax deferred, just like in the pre-tax accounts, but you do not pay any taxes at withdrawal. And typically, there are no requirements to take money out of these accounts in any type of prescribed way. So the question often arises, which bucket should I save in, pre or post-tax? There is, just like anything that we talk about, there is not a definitive 100% definitive answer, but generally you want to save into pre-tax accounts when you're in a higher tax bracket and post-tax accounts when you're in a lower tax bracket. So very simply, maybe earlier on in your career, you're in a lower tax bracket, you're not making as much, stuff the Roth with as much money as you can. Later on, as your income continues to grow, maybe over allocate and focus on putting as much money as you can into pre-tax accounts. However, since future tax rates are uncertain, we don't know where the tax code will be in 20, 30, 40 years from now down the road. It is usually a wise decision to diversify your savings buckets and put some money in pre and post-tax retirement accounts. This will allow you to strategize and maximize your withdrawal sources in retirement to be optimally tax efficient. The most common way to save into tax advantage accounts is through company 401k plans. You all should know that because you're here, you're likely saving at a minimum the maximum amount that your company matches. But since this is a next level webinar, you're presumably maxing out your 401k, which in 2025 is $23,500, and taking whatever your employer contributes as well. A little used extra tax deferred savings option is the Mega Roth contribution. This year, in total, you and your employer can put up to $70,000, and this is before the age 50 plus catch-ups, into your 401k, which means you can fill the void between your 401k contribution of $23,500 and your employer's contribution. And you fill the void by making the Mega Roth contribution. In aggregate, these 3 sources can add up to $70,000 this year. In my example here on the slide, if you put $23,500 into your 401k and your employer contributes $8,000, you could add another $38,500 as a Mega Roth post-tax contribution. That is a lot of money that you will never have to pay taxes on again. Additionally, if you're looking to continue to build out your post-tax retirement funds, you can elect for your company to put your match into the Roth bucket. I haven't seen a lot of this yet. It's a fairly new provision that came out of the Secure Act number 2, which was passed at the end of 2022. But this allows employers or the employee to elect and direct their employer to make their match into the employee's Roth 401k. Employees may have to consider the match as income in the year of contribution, but the gain grows, that money grows tax deferred and will come out tax free when you do decide to withdraw it. Additionally, even if you are maxing out your 401k, you can still contribute into an IRA and a Roth IRA. Likely, these will be non-deductible contributions, so you don't get any tax deduction up front, but you can max these out and this year at $7,500. And talk to your advisor. There's a technique called the backdoor Roth conversion that may be open to you, that allows you to almost immediately put your money into a Roth, thereby letting it grow tax deferred and pull out tax free down the line. Another type of tax advantaged accounts that I want to focus on today are health savings accounts, or HSAs. And these are truly the big winner of the tax deferred savings options. So they're triple winners because your contributions, you do not pay income tax or FICA tax on the money that goes into the health savings accounts. The growth is tax deferred. And then as long as you pull the money out for qualified medical expenses after the age of 59 and a half, you don't pay tax on any distribution. In order to have an HSA, you must elect to participate in a high deductible health plan. High deductible health plans are becoming more popular amongst employers, with recent stats showing that nearly 50% of employees have access to them through their company's benefit offerings. With high deductible health plans, premiums are actually lower than PPOs, but you pay a larger deductible before insurance coverage kicks in. High deductible health plans can be a good option for individuals or families who can pay out of pocket for medical expenses up to the deductible, allowing them to save a commensurate amount into your HSA. So you have these plans. You do need to pay more upfront, but at the same time, you're saving on a very aggressively tax deferred basis into your HSA. In 2025, the max contribution to an HSA is $4,300 for a single tax filer and just a little bit over $8,500 for those families and those who file jointly. A new client of mine who is a high-level executive at a Mag 7 company came to me with an HSA that she was using to pay her family's medical bills. Since she had plenty of extra income, we adjusted her spending plan to pay her medical bills out of pocket and invest the contributions that she's making to her HSA. By the time she's retired, she could conceivably have hundreds of thousands of dollars that can be used to pay for supplemental health care, Medicare premiums, physical therapy, elective surgeries in retirement, all withdrawals come out without paying a dime of tax. So here I want to transition to some of these action items in this category. Diversify your contributions inside your 401k to both pre and post tax. There's no perfect answer here, but I highly recommend that you save a little bit of money or some money into both these buckets so that it's giving you the most options when you need to withdraw the funds later on. And if you have capacity, look into putting money into your Mega Roth option within your plan. If you do have a health savings account, investigate your investment options to maximize the long-term growth benefits of these savings opportunities. You really could build up a really nice stockpile of assets that could go towards very likely medical expenses down the road, and super powerful. And just like with retirement accounts, or with your retirement accounts as well as your HSA accounts, these accounts are inherited by beneficiary designation, not through a will or a trust. So make sure you have your beneficiaries designated very clearly and they're aligned with what your goals are.
Awesome. Thank you, Erica. I'm sure you are. I get questions about Roths and taxability and all that all the time. So thank you for covering that. I really appreciate it. Okay, so you're actively working on building up your wealth, or maybe you've already amassed quite a bit. Regardless, what happens to that wealth when you pass? Death and taxes, the only two things we can really count on. All jokes aside, this is a very challenging topic for many people. And actually, as I was practicing this yesterday and my husband was listening in, he commented that, "Whew, this is really heavy." So apologies in advance, but this is a really important topic. Now, as you can see, the data shows us that many of us simply either haven't discussed it yet or have discussed it and not decided to execute on their documents. But the truth is, none of us really have control over how and when we leave this world. No one wants to consider a universe where they die of something other than old age. And even if you do have the luxury of dying of old age, ensuring that the people, communities, pets, things, everything that you care about is covered is incredibly important. And that's what estate planning does. It allows you to shape your legacy. So if you don't have an estate plan, you're not alone. As you can see, only 32% of Americans actually have a will. Many individuals and families can just make meaningful progress by putting just a few foundational documents in place. Those include a will, a healthcare and financial power of attorney, and a healthcare directive. These documents help ensure that your wishes are honored and your loved ones aren't scrambling in a time of crisis. If you don't have one, if you don't have those documents, and it's been on your list for a while, and you don't have a financial advisor to nag you on this, just tell a friend. Tell a colleague. You're not giving them personal information. You're just asking them to be your accountability buddy. Or email an estate attorney. We have plenty that we love and work with closely. And just tell that estate attorney you need this done in 2025. The bottom line is you need to let someone else nag you on this. We are way more likely to do something if someone else is dragging us, even if it's kicking and screaming. Something else important that you can do while you're putting these documents in place is check to make sure that all of your accounts have beneficiaries, including but not limited to your checking accounts. I'm sure Erica can attest to this, but I cannot tell you the number of times where we're helping an executor manage an estate, and the most challenging piece is a small checking account that someone forgot about that maybe has $50 in it. It's certainly not nothing, but the amount of time and energy it will take you to access that $50 is substantial if beneficiaries are not in place. Another question we get a lot, yes, you can add beneficiaries to your taxable accounts. They're not just on 401ks and retirement plans or IRAs. Sometimes the account is actually a trust, so it doesn't necessarily need a beneficiary, or sometimes the beneficiary is a trust. Again, working with a financial advisor and estate attorney to determine what structure your estate plan needs to take is the best next step forward. A question we get a lot, and Eric, I'm sure you get this one a lot, is do I actually need a trust? I've been hearing about them. Do I need one? And the honest answer is, again, it depends. Not everyone needs a trust. For some family, a trust can offer powerful benefits, but relying on your estate attorney and your financial advisor to help you make that decision is really important. A couple of examples of where a trust might actually be helpful. You may have financially inexperienced heirs. Trusts can dictate how funds are distributed over time or based on different milestones, like graduating college or turning 30. You can also use trusts to protect assets. For example, in some irrevocable trusts, you can shield assets from creditors. So if you're in a high-risk career path, having some type of protection plan in place might make sense. There are also ways that you can have a trusted person come in and manage your financial assets if you are incapacitated for some reason. Again, many reasons why you may need a trust. It's all very personal and depends on what your goals and objectives are. A couple of estate planning musts that often get overlooked. If you have college age or adult children and they're over 18, you legally can't make medical or financial decisions for them without a signed power of attorney. Make sure you can advocate for your children in the event that they can't advocate for themselves. So that includes getting powers of attorney and having that discussion with them about what should happen if something happens to them and you need to make decisions for them. Pets. Don't forget to include instructions for your four-legged friends or any other pet that you may have that you care about. Collectibles. Keep an inventory and outline how they should be distributed or cared for. Same goes for intellectual property. Treat it like an asset. Make sure there's a plan for it. Something that we see a lot that we get questions on is your travel points. Some people have racked up a ton of travel points. And yes, they are very valuable. Know the rules that your credit card or however you get travel points is how those rules are executed. Make sure you understand them. Make sure that there's a plan in place. All right, so action items for today. Give yourself a deadline. If you haven't done this yet, make it 2025. I encourage you to get it done. And again, tag an accountability buddy. If you need an estate attorney, if you need a referral, or if you want to chat through it, I know Eric and I are happy to have these conversations with people. All right.
Right. Thanks, Olive.
Yeah.
Awesome information on estate planning, which I tend to think of as a risk management mechanism, just to make sure all your hard-earned wealth is well protected. If you cannot speak for yourself or you're no longer around. Another important risk management consideration is insurance. And today I'm going to focus on disability insurance. And Olive will follow up talking about life insurance. But we really want to make sure that your assets are protected and you have the mechanisms in place if something were to happen to you. Disability insurance, it's a somewhat narrow term for the scope of this type of coverage. It's better to think of it as income replacement insurance. Disability insurance safeguards your family's lifestyle in the unfortunate case that you lose your income due to injury or illness. In a somewhat surprising stat to me, 1 in 4 people will become disabled at some point in their working career. That doesn't mean that you are never able to work again, but that you have to take time off to care for your health at some point. Most commonly, this looks like a leave of absence due to an illness such as cancer, a prolonged recovery from a surgery, or a protracted period of time to focus on your mental health. Different than when life insurance becomes relevant, disability insurance isn't just needed to support your family, but also you. So beyond planning for your family's needs, such as childcare, college savings, regular everyday expenses, you also have to consider what your needs may be if you're focusing on your health. Some extra expenses might include medications that are not covered by insurance, travel expenses to out-of-state doctors, home improvements to meet your new needs. The list really could go on. Short-term disability insurance typically covers the first 90 days of time off due to a qualifying disability. Typically, your employer has this coverage for you, and on top of that, you should have an emergency fund that can fill in the gaps. But most impactfully is the possibility that you're out of work beyond 3 months when short-term coverage expires, and you need to rely on long-term disability insurance. Long-term coverage will typically run until age 65, when it's expected that Medicare will cover your needs. While your employer may offer long-term disability coverage for you to purchase, or they may actually even cover the cost of it for you, there are imperative questions for you to ask to confirm that you are comfortable with the coverage levels. And that's really where we're going to go into the action items. I'm going to go through a lot of these questions that you really need to dig into to make sure you're comfortable with the coverage, and then possibly decide that you may need to supplement disability insurance with purchasing your own policy. So when you're investigating your workplace policies, ask yourself these questions. Do I have short-term and long-term disability benefits? That one's going to be pretty obvious. That should be in your benefits package. That you should know basically. And also, do I have to opt into those? AKA, do I have to buy that coverage, or does my company pay the premium, thus thereby giving me coverage? A really important follow-up to that second question is, will my benefit be pre or post-tax? So in the case of when an employer is paying the premium for you, it is likely that that is considered a pre-tax benefit to you. So if you were to ever start to collect that coverage, if you were to make a claim and start to collect benefits from that policy, that money would be taxed as income to you, thereby reducing your benefit quite largely, because part of it is going to pay income taxes to both the federal and your state government potentially. So really hone in on, is the benefit that you're going to get from the insurance coverage that your employer offers going to be pre-tax or post-tax? Obviously, ideally, it's a post-tax benefit, so you are getting the gross amount in your account to cover your expenses. Another really important question to ask, is this own occupation or any occupation coverage? Own occupation coverage is, well, I'll start with any occupation coverage. Any occupation coverage is essentially, it will only cover you if you are unable to essentially be employed in any job. So say you're a surgeon and you have a very highly specialized skill set, and you start to perhaps you develop Parkinson's and you're no longer able to perform the intricate surgeries that you're trained for. If you only have any occupation coverage, that means technically you're not, as long as you're able to do some clerical work or, have research or something else, you may not be able to collect on your insurance. So it is imperative and crucial that you focus on own occupation coverage, meaning that you are unable, if you become disabled, you're unable to work the job that you are specifically trained, educated, skilled at, then the coverage will cover you. And lastly, another really big question is, does the insurance coverage that your employer offers, does that look at your salary and whole, meaning what you earn as a salary and your bonus, or is it just your basic salary? So because disability insurance is often a percentage of the income that you were making previously. So you want to make sure that it's covering the largest amount of your income, which would include salary, bonus, and other forms of earnings, not just your base salary. And at the end of the day, if these questions are insufficient and you get down to it and the coverage is insufficient for what your family may need if you do become disabled, you do likely need to go out and try to secure some extra long-term disability insurance for yourself. I know these are a lot of questions. It can be kind of complicated. There's a lot of details and reading between the lines and asking the right questions. So this is where, as advisors, we're really helpful in terms of partnering with you to try to get to the bottom of the questions that you need to know.
Awesome. Thanks, Erica. Sorry, guys, really cheery topics today, but super important again, as we just want to protect assets and make sure that if the worst should happen, you're still in control. And that's what these things do. So last one on our list today is life insurance. When you think about life insurance, there are two questions you should ask. How much coverage do I need? Why do I need it in the first place? The core purpose of life insurance is to protect your loved ones and your assets in the event of your passing. The right amount depends on your financial obligations, income replacement, and long-term goals. And like estate planning, having a trusted advisor, whether that's an insurance broker or a financial advisor, to help you navigate what and how much is crucial. You may have heard of term insurance. It provides coverage for a specific period. It's typically 5 to 30 years. It's designed to protect you during your prime earning years, usually between ages 25 and 65. It's the most cost-effective way to ensure your family is protected if you pass away during your working years. Whole life insurance includes permanent, variable, and universal life policies. These are designed to last your entire life and often come with a cash value component. Whole life is typically more expensive, and it can be challenging to figure out the right amount. So it's sort of a specialized tool. It's great for some, unnecessary for others. Back to what Erica said about employer provided life insurance or any type of insurance. It's a great benefit, but make sure you know what it is. Make sure your partner and your spouse know what it is. I have so many conversations with people where they know they have it, but they don't know how much and what are the parameters. It's usually low or no cost to you, so that's good. It's a very easy first layer of protection. And if you're job hunting, it's a benefit you should definitely be considering as you're looking for other opportunities. The problem with employer insurance is that group policies may not be portable. If you leave the job, you may lose coverage. Just being aware of that and knowing that you may need to supplement if you choose to leave that job, really important. All right, so as we think about how much you actually need, start answering these questions. What are my outstanding debts? How much does my family rely on my income to cover essential expenses? Do I want to fund specific goals if I pass? How many years of income would my family need to feel secure? And it's not just earned income, right? If you are someone who provides for the household in another way, making sure that if you pass, the services that you offer are covered. They are valuable, even if it's not through a traditional employer, making sure that those services are replaced if there was something that happens to you. Other types of insurance that we didn't cover today that you should consider or just look into, long-term care insurance. Definitely know what your homeowner's insurance covers, what your limits are, what the parameters are. Check your property and casualty insurance. See if you have umbrella insurance, and then car insurance. All of the fun things, but very important for you to know, be aware of, and be able to track down easily. So, life insurance, determine what your current benefit is through your employer, supplement where necessary, determining what you actually do want to have covered if you were to pass. Really important. Okay, we are going to jump into some questions now. This PowerPoint will be available for folks to download, but again, these are the simplified, simple, but very powerful action items that we want you to take away today. All right. Erica, you got some questions for us?
Yeah, and just a reminder, you can enter questions in the Q&A section at the bottom of your Zoom. So if anything has come up as we've gone through the webinar, please feel free to add those. But yeah, I do have a couple here. I will start off with the first one that I see. And it is, how do these strategies differ for women in different life stages? Example, those in their 20s versus their 50s. Well, I think we agree, Olive and I agree that all these steps are applicable no matter your stage of life. They may look different based on your income, your family situation, if your goals are short or long, which goals are short and long term to you, but they're all relevant no matter your stage in life. We hope we've made clear that this is a way to take control of your financial situation at any point in life. It's not to say that you may not need to revisit or reassess these your situation down the line. We all know personal situations evolve, but we sincerely believe that everyone should be thinking about these 5 steps as a way to firm up their financial life today and really, feel most in control.
Other questions, Erica?
Yeah, so another question is, do you have any advice on how to budget when saving for your first house?
Great question. Obviously, I've got friends that have been looking for a number of years. It's a challenging market. Interest rate environment isn't what it used to be. As you think about saving for your first house, make sure you are also saving for expenses that come up when you buy that first house, right? So if you think you need X, probably you need X plus Y. The other thing I would say is that don't make yourself house poor. There's a lot of people out there that might say, where you live is obviously super important and is a massive investment, but don't stress yourself out to the point of not feeling like everything else in your puzzle is fitting together. right? So as we think about a plan and we think about the potential room that you have based on your cash flow for a house, make sure you're mindful of, where exactly that number is. And then in terms of on the investment side, it's obviously challenging if you're not sure when you're going to buy a house. So having some flexibility, making sure that your portfolio is well diversified so that, again, if you walk into the house of your dreams and it fits into your financial plan, you have different levels in your cash flow and also in your investment portfolio that you can pull to fund that investment. And that's true for any goal, right? It's true for a car, a house, a college, making sure that you have a well-diversified portfolio so that, again, as the markets move around on us, which they will do from time to time, you're invested in different parts that move in different ways. So.
Great advice. Okay, so another question that just came in was, and I'll take this one. Could you repeat the beneficiary recipient for pre and post tax accounts if there was a will or trust in place that states something different on the beneficiary form? So I think what's being asked here is what is the difference between naming beneficiaries on certain accounts versus what you have directed and dictated through your will and trust? So it can be somewhat confusing, but there are certain types of accounts that transfer to the inheritor only by naming them as a beneficiary on the account. And these are primarily retirement accounts. So 401ks, IRAs, Roth IRAs. It does also include HSAs. There are other accounts in which you must name a beneficiary. If you do not, then the accounts, those assets will go through a very complicated process of probate when you die. And it's something that you really, for everyone involved, want to avoid. So, you can name a trust as a beneficiary of a retirement account or any of those accounts. You can name a spouse, you can name children, you could name a charity. There's different reasons why you would put different people on different types of accounts based on their taxability, but you want to make sure that you have that information on those accounts, and that's typically that information is held by the custodian who oversees the assets in those accounts. They're after-tax accounts, so primarily individual accounts, joint accounts, trust accounts. Those are going to flow based on what you have written in your estate planning document. And so in some cases, like on an individual account, and this is where Olive mentioned things can get kind of confusing, or, there's some different routes you can go. You can name a beneficiary to an individual account, but I would say the thing that probably gets most overlooked is naming beneficiaries on retirement accounts. So be very certain that you have done that. And I just like to also reiterate, you may have done this 20, 30 years ago. Your intended beneficiaries may have changed since then. I had a very unfortunate situation with a client who had a friend originally named as a beneficiary on a 401k, someone she was very close with back many, many years prior. And when she passed, her brother thought that he was the intended beneficiary. And it turns out she never changed it. And there was absolutely nothing you could do legally to get that funds to him. And so it is crucial that you make sure and check with the custodians of each of these accounts that your beneficiaries are named as you desire. Hope that helps. Olive, there's another question. For someone hoping to start a family in the next few years, what are some things to think about? Should you be thinking about future investments accounts for the kids?
Absolutely. I would say first you should think about if you're working and if your partner is working, how are we going to pay for childcare? Childcare is very, very expensive. And honestly, even paying for your own care while you're in the hospital. So I congratulate you for talking about this earlier rather than later, because it allows you to be better prepared. But children are a wonderful blessing. They are expensive. making sure that you are understanding, number one, what is covered by your insurance. Number two, what your employer benefits are is really the first step. If we're going to go and deliver this child at a hospital, what is our bill going to be? And also push back, call about that bill, call and make sure that they've gotten everything done correctly. And then also call and make sure you understand the payment options. Not all of it has to be a lump sum. So spreading some of that cost out can help. So fast forward to, okay, now you want to go back to work and, have to pay for daycare. Again, figuring out in your cash flow what works and what doesn't work. For some people, they feel very strongly about having someone stay at home. And so obviously the cash flow looks a little different, because if you have two working parents and you go to one working parent, cash flow looks different, but maybe the trade-off of what you pay for daycare makes sense. Talk about that. Are one of you more interested in staying at home with the kid versus the other? Fast forward, you have a child, start to plan for, what comes next. In terms of college, I know everyone is very stressed out about paying for college tuition. I would start thinking about how you can fund that education. But I think it's really important when Erica and I talk to clients and we're talking about college funding in 529s or, college accounts like that, we're not necessarily saying you should save 100% of what you're going to spend on college in that account. Actually, you're probably closer to 75% of funding, because if you don't use that account for college spending, there are taxes and penalties associated with it. So I think you're doing the right thing by asking the right questions. Continue to do your homework, continue to research. Make sure you're talking to your partner about this and you both are on the same page about what your plan might be.
Awesome. I think we might have time for one or two last questions. So if there's anything on your minds that you want to make sure we address here in the next couple minutes, please send those in. We did get one question in advance about, are there any tips specifically for single moms or women supporting families alone? So I wouldn't say there are any specific tips that come to mind right now. I just say that planning and documenting just becomes all the more important. Some people see single as very liberating, others find it challenging, but no matter how your mindset around it, you want to protect your hard-earned wealth and make sure your assets, and I think of children as your biggest asset, and your financial assets are in good hands if something were to happen to you. I just wrote a piece on the importance of risk management for single women, and it focuses on insurance for estate planning. Focuses on insurance and estate planning as risk management tools for single women. So I'd recommend that you go to our website or LinkedIn page and read it if this, you continue to have questions and would like to learn a little bit more about this. And of course, reach out to us if you really want to delve deeper into it. All right, Olive, do you want to hit on one more of the pre-submitted questions?
Sure.
Okay, you pick the one that you think.
Okay.
Well.
The question we get a lot is, do I spend and prioritize my future self over my current self? And that sometimes includes paying off debt, right? So lots of us either have student loans or credit card debt or fill in the blank. I would treat debt like one of the financial goals we discussed today. Have a goal set that you want to pay off your debt in X amount of time. There is some debt that you should prioritize, like credit card debt that's high interest. So if you can pay that off quicker, that makes a lot of sense. If you're trying to pay off debt and you find yourself continuing to add to your credit card bill, put the credit card in a drawer maybe. Try and switch to a debit card, be really mindful and make sure that you get that credit card bill down. There's other debt that potentially you could leave. If you were one of the lucky ones that got a mortgage refinance or purchased your first home when interest rates were really low, you don't necessarily need to be aggressively paying that off. Obviously, keep up with your payments, but you don't necessarily, unless it's keeping you up at night, need to be paying that off aggressively. So every debt is different. So you should have a plan based on what actually that debt is set up to, do, and also the payment that you're having to incur that debt is really important. But it varies. It totally varies. And to treat it like a goal, again, just make sure you're focused on how long and how quickly you can pay that off.
Thank you. All right. That, I think, is all the time we have today. We really want to thank you for spending this time with us. We hope these 5 steps give you some clarity and confidence to move forward and are inspired to take action and to take that next step, no matter where you are on your financial journey. If you'd like to talk through anything we discussed today or dive deeper into a specific situation, don't hesitate to reach out to us. We'd be happy to schedule time with you. You can scan the QR codes that are on your screen. I think there should be a link in the chat. I don't see it, but use the QR codes and you can schedule time for us that works for you. Thanks again for joining us, and we look forward to seeing you next time.